right now we got to pivot back to Microsoft because those shares, as I pointed out, are falling sharply by more than 11% as the company's CapEx spending plans spook investors, despite the fact that they topped second quarter earnings estimates. Joining me now is Rishi Jaluria, RBC Capital Markets Managing Director of Software. Rishi, it's good to see you. And hopefully you can sort of walk us through what's going on here, because I find it really interesting that sometimes investors hate more spending and sometimes they don't. Meta is an example of where they don't hate it today. Microsoft is an example of where it is seemingly more alarming. Is it just because like Azure is missed maybe some estimates? What's going on here?
Yeah, and thanks so much. Always a pleasure to be on your show. Look, I would say there's a couple things going on, and it's interesting you bring up the Meta comparison, because 90 days ago everyone hated Meta's CapEx plans, but obviously they had a strong quarter, and you see that being reflected in their stock action today. With Microsoft, candidly, it feels like I'm missing the forest for the trees type of moment. Absolutely, people are picking on the CapEx numbers. The CapEx numbers were actually pretty in line with my expectations, but definitely above where I think the rest of the street was. And Microsoft has been telling us for a while now that they are capacity constrained, that they want to bring all this third-party capacity. Think about these deals they have with Oracle, CoreWeave, Nebius. They want to bring all of that back in-house. That means that's a lot more they need to spend to build out that capacity. And they're telling us that effectively the Azure numbers would have been meaningfully higher if not for the capacity constraints that they're facing. And so, it's almost like Microsoft's kind of stuck from an investor sentiment standpoint in the middle where, look, the Azure number I thought was strong, right? I mean, you could say, oh, it wasn't 39%, it was 38% in constant currency. But the fact is they added somewhere in the neighborhood of $9 billion of constant currency Azure ARR sequentially. And it was a broad-based beat. It wasn't just OpenAI, or it wasn't just AI, it was everywhere in the portfolio. And there's a lot more to talk about the print, but maybe it wasn't necessarily high enough for people that wanted a higher number, and the CapEx numbers are going up. You don't spend money on CapEx and build out data centers and immediately have that translate to revenue. These things take time to translate. I think it's creating a buying opportunity in this increasingly fickle and impatient market.
Well, let's dig into this timeline a little bit more, Rishi, because you wrote about this in your note as well. This problem of these capacity constraints. So if capacity is the problem, how long? I mean, it takes a long time to build out capacity, especially if they're building some of these data centers from the ground up as opposed to acquiring or what have you. Like, what does the strategy look like there for Microsoft, and how long until they can expand that capacity?
Yeah, look, I think they can start to expand capacity slowly right away. And we start to see more 1P capacity come online. I think Microsoft has a multifaceted strategy to be able to meet demand. There is the building of new data centers, owning those, and those have ROI for a very, very, very long period of time, which is great because with Microsoft, you want fungible architecture that can be repurposed from training to inferencing, reasoning, post-training, et cetera. They're also doing third-party leases. They're also doing third-party data centers. So anything that they can to bring more capacity online, they are doing that. Now, the question becomes, well, when can they hit a point of parity in which they are no longer capacity constrained? Look, it's not going to happen until at least the end of their fiscal year, which is June fiscal year end. It could be after that. It just depends on the rate of AI demand. And look, I mean, clearly we're dealing with unprecedented AI demand given the arms race going on between the model providers. But you're also seeing this uptick in enterprise AI demand. And I think that's what got lost in the noise around Microsoft's print is a lot of the data points it gave us, be it Fabric, GitHub Copilot, M365 Copilot, we're strongly encouraging that we're starting to see the AI tailwinds not just be about brute force training of models and capacity build-outs, but there's actual enterprise adoption. And I think that's what's needed for this kind of AI trend, today's stock market action notwithstanding, to really continue, and for that all-important moment that everyone's waiting for when we start to see that kind of rotation from semis into software.
Rishi, I did think that was, some of the data points that you brought up I thought were really interesting. That 15 million subscriptions for M365 Copilot, the contribution from OpenAI to net income of $7.6 billion was also interesting. I'm curious, as they give us sort of this transparency, if there's anything else that you want from Microsoft in terms of data, are there other questions that you have about as they sort of shift the business model that would help you kind of analyze the company?
Yeah, look, I think what could really help us is, it's good to get some of these paid user numbers, and one metric, by the way, that really stood out to me in addition to the M365 Copilot number was Microsoft Fabric reaching $2 billion of ARR, up 60%. Bear in mind, they launched that product less than 2 years ago. So I think that's a very, very impressive trajectory we're seeing there and showing the kind of strength and breadth of Microsoft's portfolio. What I really want to see, though, are some really strong user engagement, user value metrics, because there's always going to be new fears that pop up. Now it's people asking about Anthropic Claude Cowork, but really I think if we can start to see data points of users are spending more time and engaging more with the Office suite because of M365 Copilot and all these AI-enabled features, that more developers are spending more time putting more code in GitHub because of GitHub Copilot. If we start to see that, I think that's a great leading indicator for future monetization, because really, the way we think about AI monetization in software is it is innovation, utilization, monetization. And so I would love to see more of those forward-looking indicators, but I do appreciate the greater transparency that Microsoft is giving us now.
Rishi, on the point about OpenAI, they gave that net income contribution number. It seems like even without that, they would have beat estimates. That said, it seems like there is some concern out there about how leveraged they are to OpenAI, the relationship with OpenAI. Is it a liability or is it a benefit?
I think it's actually a strength. Look, I think the more important number that's coming out is that OpenAI represents 45% of commercial RPO. That's basically a measure of think about as forward-looking backlog. Now, I think that's a conservative number because they are kind of risk adjusting it, especially on a duration impact. But I think two things are really important here. Number one, OpenAI is still, for all the kind of gains that Anthropic and Google with Gemini have made in 2025, OpenAI is still also at the cutting edge of this, right? I think it's candidly a three-horse race and it's an oligopoly between these three model providers. And Microsoft still has research rights till 2028. They have IP rights until 2032, which includes AGI, and that means, by the way, no gross margin drag. They have API access. So I actually think that OpenAI relationship is a huge strength for them. But the second thing that I would say that I think gets missed a lot is when we think about all these applications that they built, be it M365 Copilot, GitHub Copilot, Dynamics, security, et cetera, they're all built in a modular fashion. That means they're model agnostic or actually multi-model in nature. So you can choose to use OpenAI or Anthropic or even open source, be it Mistral or Llama, under the hood of these. And so the future fortunes of them at the application layer and the developer layer, the security layer, are not dependent on OpenAI. It's dependent on AI as technology and these models evolving. And I think that gets missed as Microsoft has built these products in such a way and hedged their bets that, even though obviously OpenAI doing well would be a good outcome for Microsoft, the future of Microsoft is not entirely dependent on OpenAI.
Rishi, I wanted to broaden it out a little bit, and I want to play for you something that Kim Forrest of Bokeh Partners told Josh Lipton, who you know well. He asked her how software businesses navigate this LLM future, because as you know, many of them have been underperforming, and I want to play for you what she said.
Well, I think people really are leery of things like Salesforce that have been growing because they've been adding functionality. And now people think, well, you could just, use Claude and write whatever you want. Well, as an ex-software engineer, good luck with that. I think it can help people write code, but I'm always kind of skeptical about that.
And so I wanted to get your take on that, Rishi. This sort of cavalier assumption that, we don't need these enterprise software companies anymore because people are just going to vibe code everything.
Yeah, no, and I fully agree with what she's saying. Look, I would say this is, yes, barriers to entry in software have come down. You and I could probably create a software product that's a minimum viable product, get it out in the market with $500 in 6 months of time. And I'm not a software engineer by trade myself. But I think this is a great thing. It means the software TAM is going to grow. It means more innovation, and more innovation means more customer success. And that means a larger TAM that we can go after. And so I agree, like enterprises are not going to be vibe coding. Where I think it creates a little bit of pressure on a company like Salesforce is the ability to upsell new products, because customers are going to say, hey, we see that barriers to entry are coming down. We're going to push back on price increases. It'll be harder to expand. So I think there's some there at the margin, but that's also missing the opportunity that so many of these companies have to actually double down on innovation, double down on customer success. I would point to a company like HubSpot, for example, or even Microsoft that we're talking about, where they can actually double down on AI, actually innovate around it, and not just bolt on an agent or two, but really go AI first and AI native. And there's ways to really monetize that in a meaningful way over time, to the tune that I think we can look at 2x to 3x customer lifetime value from true AI native products that can do things that we couldn't under the traditional SaaS paradigm. And I think the market is outright missing that in so many of these software companies out here. And I think, especially with today's pullback, it's created so many great buying opportunities that I truly believe we're going to look back at 3 years from now and say, I wish I stepped in. Okay. And that's the time for us to step in.
What's going to make the market realize that? I mean, I'm looking at a HubSpot, for example, that's down 29% over the past year. What changes to, for the light bulb to go off?
I think two things need to happen. Number one is we need to see acceleration in growth, right? No, accelerating growth just cures all manners of sin, no matter what the bear narratives are. And we've seen this play out last year with MongoDB, Snowflake, Datadog, et cetera. And so HubSpot, for example, is a name that I think can actually see acceleration without the benefit of AI. I think the AI story starts to show up in monetization in 2027, but even this year, I think they can accelerate. Same with Intuit, same with Microsoft. And I think it's accelerating growth is piece number one. But I think piece number two is actually showing proof points around AI. If HubSpot or Intuit or even Microsoft has started to show us metrics around this as well. If they can show metrics that customers are coming to them, they're using their AI solutions, they're getting real value out of it, it's driving greater engagement, and they're not instead escaping to adjacent solutions on the model providers, I think that starts to really poke holes in that bear case, on this existential AI and software bear case. And I think that really starts to kind of show how dislocated some of these stocks are. So those are the two things that we'll be watching for during this earnings season and beyond.
Rishi, I feel like if there was a table in front of you, you'd be pounding it. You're fired up about this stuff. I love it. Thanks so much. Appreciate it.
Thank you so much.
Take care.
Out of all these quarters that just reported, which one did you love and why?
Well, listen, I don't own Tesla and I don't own Meta. So I looked right at Microsoft because it's one that I own. It's one that I like. I wasn't fazed at all by the negative reaction that we saw in Microsoft. You made a couple of very key points. I'm in it for the long run. I think the reaction is an overreaction. I think it, though, provides an opportunity to buy a quality name at a discount. Now, look, Meta shot straight higher after Zuckerberg got done, and that's great. And look, they got an $800 price target on it. I think it's traded $7.25 right now. And Tesla, I think, made some very interesting comments, to your point, about stopping production of the X model and the S model and moving more into humanoid robots. And I think that is going to, in fact, be the future. He's made it very clear that's where it's going. So I think there's an opportunity in Tesla for anyone who doesn't own it, like me, to take another look at it and to jump on. But I was while Microsoft was a negative reaction, I look at it as an opportunity to pick up a quality name at a discount.
Kenny, as if I needed a reminder why you're my favorite, I am reminded today because you always shower me with praise, love, appreciate it. Ellen, I'm going to stay on Microsoft. Kenny's fired up on Microsoft. Did this quarter excite you? The street not liking what they had to say on CapEx, the cloud sales, maybe not so good. I mean, they did grow strongly year over year, but there were some negative points in this quarter from MSFT.
So as I look at Microsoft, I think the key thing that was problematic, not only the Azure revenue year-over-year growth missing by a little bit, not too bad, but the free cash flow just plummeted, right? It was down to $5 billion. It's usually in the 20 billion range. So what we're seeing is Microsoft is spending all this CapEx. Okay, fine. But you need to be able to have cash flow from operations to fund that. And they didn't have that. And then you look at the CapEx that they're projecting for this year, and it's going to be problematic as well. So I think the question is, and why the market likes Meta so much more right now, is, are you going to be able to see the return on that investment? And with Microsoft, they're talking about, yeah, we have 15 million Copilot paying subscribers, which is kind of a small number when you think about the scale of Microsoft corporate business altogether. But are they going to be able to get the return on that? Meta put up the numbers, and we'll see what happens. The thing that concerns me is that they're talking about 115 to 135 billion in CapEx this year, Meta. Last year, they had 115 billion in cash flow from operations. So they better start producing increased cash flow if the market is not going to penalize them next quarter when the CapEx shows up in their free cash flow numbers.
Ellen, as a former analyst, I love that you're coming up here on our roundtable talking about FCF, that's free cash flow. Inez, coming over to you. Look, these Microsoft earnings calls have gotten really boring. I barely even know what they're doing anymore, full disclosure. It's become such a complicated company. But I'm listening to this call, and then Satya drops this nugget that 45% of Microsoft backlog is tied to OpenAI. And if you're concerned about circular financing as it pertains to AI, that is a number you don't want to see.
Exactly. The circular financing is something that the street has really been concerned with. And you've seen it with some of the sort of stock performance from some of these companies, especially also when it comes to software companies. These have not performed so well. But, going back to these reports, look, I think that I agree that with Meta, they have been able to show several points that agents are working. Their shopping tools are getting better, and this is very significant for their bottom line. And also talking about even productivity within the company. I found it so interesting that they said that since the beginning of 2025, per engineer, they have seen an increase of 30% output, that their projects that used to take now a lot more people are taking less people. I think that these are some of the signs of why you're seeing sort of the divergence in the stock performances between, for example, a Microsoft and a Meta that was able to highlight some of these points.
All right, let's keep this cooking here. That was good Microsoft analysis. Kenny, I'm going to go out on a limb and say that you don't have a Model S or Model X. I think you're a gas-powered car guy like me, and that's cool, man. But why we should care about what Elon said about S and X, and if you like Tesla, you got to care, because now he's going to take those factory lines and he's going to start pumping out humanoid robots. At some point, Elon's got to, we need to see these robots, and they need to start making money, and they need to start making money real soon.
Right. And I think, he's taking us down that road. He's made it very clear that that's where he wants to go. And he's even showed us, right, in certain, you can see it in expos, you can see it at conferences, whatever. He brings out the robots, they talk about it. I think it is the future. I think he's going to bring it there. Look, Elon Musk doesn't promise and not deliver. He promises and he delivers. And so it's a matter of time of, converting that manufacturing from cars to these robots. But I suspect that it's going to be very exciting, and I suspect that he's going to do it, and he's going to do it in a big way.
Ellen, let me lean into your balance sheet analysis skill set. We were just listening to you talk about free cash flow on Microsoft. When Elon Musk hops on an earnings call and drops this mini bomb on everyone saying, we want to build terafabs, essentially a big giant building that makes computer chips to fund his various ambitions on robotaxis and humanoids. Do you want to hear that from an investing standpoint? Because that is going to suck up free cash flow, and that could impact the stock's valuation.
So Tesla has never traded like a normal stock in terms of valuing it on free cash flow or earnings or any kind of traditional measure. So on the one hand, yes, as an investor, that bothers me because that's a very expensive proposition. On the other hand, as a stock investor, I don't know that that's actually going to end up mattering to Tesla's valuation and how the stock trades. It's like a number of other companies where the free cash flow has never really mattered to investors, at least based on the stock price. But that said, fabs are really expensive, and we don't have the infrastructure to build them here in the United States in the same way that Tesla is talking about. So, for example, I was looking at the Lam Research Quarter last night. They're a semi-cap equipment company, and they're global, right? They sell to Korea, they sell to Taiwan, they sell to the U.S. They're dominant in their etch and deposition subsector. They had 5% of revenues from the U.S., okay? 20, 30% from China, Korea, Taiwan. And so unless we see the infrastructure being built out in the US to support fab growth, right? It's not just the fabs, it's all the components, all the suppliers, all the labor. It's going to be really hard for Tesla to build a mega fab in a way that's going to be profitable, that's going to have the yields that they need, that is going to generate the long-term free cash flow. So he can build it, maybe investors won't care about the free cash flow because historically they haven't. But I think there's also a bigger question about whether or not that can really be successful, given what we see about semiconductor capacity build-outs in the U.S. right now.
Inez, real quick, do you view Tesla as a car company?
No, I mean, it's now autonomous. It is about robo-taxis, and it is about it's about their Optimus. I mean, he's made it super clear about that and how it will change. I mean, the future is autonomous. And if I were an Uber driver right now, I'd be shaking in my boots because they see the vast majority of miles being autonomous.
Well, we're glad you're not an Uber driver, Inez, because we need you on this roundtable. And before I go, big moment for Yahoo Finance. We have launched our Polymarkets hub right on Yahoo Finance. It's an amazing site. I was scrolling through this, guys, this morning, and one prediction area caught my attention is who do people think will be the largest tech company by the end of June? Let's toss that up on the screen. It was pretty fascinating. Kenny, it's a battle between the likes of NVIDIA, Google, and some other big cap tech names. Who do you think is best situated to be the largest tech company? Is it still NVIDIA moving forward?
NVIDIA's right up there. If it's those four names, I am going to go with NVIDIA. If it's Microsoft, Apple, and Alphabet, if that's what we're looking at, I'm going to go with NVIDIA.
Ellen, another one I was just briefly scanning this morning was who will have the best model by the end of January. I mean, of course, it's almost done because January is almost done. But Google, 100% of people think that Google will have the best model in the market. And I hear what Kenny's saying, but Google's making a strong case to at least, if they don't make it to June, end this year as the world's biggest company.
I think Alphabet has a really good shot at getting that because they have a much less capital intensive model than NVIDIA, even though they still are spending a lot of capital, but they are able to grow advertising. They're able to catch up with OpenAI when people thought they were left for dead a year ago. So I would go with Google on this one.
And as I assume you're coming in here with NVIDIA.
Hands down, Alphabet,
wow.
definitely.
Wow, okay.
Yeah.
Okay. All right.
They've got YouTube, they've got the ads, they've got Gemini, they have all of those, as was just mentioned.
Nez, you're always full of surprises. I appreciate you all. Amazing analysis on a big morning for earnings. You are all the best.
You see opportunity, Alex, because listen, you know these names so well, and so I'm just very curious to get your take on the report. Microsoft, for example, which is getting nailed today, Alex. The spending continues. Capital expenditures for Q2, nearly $38 billion. That exceeded what the street penciled in. Meanwhile, Azure jumped 38% when adjusted for currency. That just met analyst predictions. Copilot, so it's AI assistant, 15 million users. Maybe some folks were hopeful they would see more there. And I wonder, do you think what's going on is just big picture with Microsoft, Alex? Folks are wondering, where is the payoff, Satya Nadella, for all this spend?
So it's really interesting. I think Microsoft is a very large and complicated business, but investors like to boil things down into something simple, which is there a part of the business that's really exciting, that's accelerating growth, that can drive the rest of the business to accelerate as well? And for a long time, that has been Azure. And Azure has been growing, and it's the fifth straight quarter of kind of high 30s growth. And a year ago, if someone would have told people that that's the growth rate, they would have been really, really surprised. I think right now, investors were very surprised that instead of accelerating growth, Microsoft made the kind of unique decision to allocate scarce resources to their own products and their own research efforts at the cost of acceleration. And so it's just a really unique phenomenon that folks haven't really seen before to this degree and magnitude. I think it's the right decision for the business. I think Microsoft feels like, look, we've got 15 million Copilot seats. We've got 450 million Office user seats. If that's a 3% penetration for a technology that we think is going to be the cornerstone to the future of how people work, because today it's a Copilot, tomorrow it's a coworker, as some wonderful LM companies are demonstrating for them. And we can't lose, we have to win that battle. We have to win that ground. And that is a higher margin business for us overall longer term. So their view is if we can divert, we're in a GPU constrained environment in terms of how much capacity we can bring up. If we can kind of divert more resources there, we can get a much better holistic kind of AI driven business over the long term, as well as on the research side where We think they will and are working on some of their own proprietary frontier models that will ultimately increase their competitive positioning vis-a-vis companies like Google.
Alex, you mentioned ServiceNow, and I do want your take on that one too, because you look at that sales outlook in the current quarter, it was stronger than predicted, Alex, but again, clearly just plenty of investor skepticism about the AI strategy here. I know you tell your clients, listen, this one's a buy. How come?
Look, we think at some point, companies will start to see more agents being adopted inside of the four walls, accessing privileged information, interacting with all manner of critical systems. And at that point, there's going to need to be a platform that, IT and technology leaders trust, depend on, to manage, control, and shape how those agents are working. Today, we have IT departments for people that use technology. Tomorrow, we're going to have IT departments that manage the agentic spread and kind of swarm happening in companies. And we think ServiceNow is extremely well positioned to do that. They have done a few large deals over the course of the last few months that I think spooked some people. We think that they have kind of taken the necessary pills to expand into other markets and other adjacent opportunities, as well as amplify some of the innovation that they were driving internally that's going to unlock accelerating growth. And quite frankly, investors are saying, if you're not accelerating at a time when you're telling us the markets are expanding, you're spending so much money, industry writ large, on capital expenditures to grow this pie. If you're not accelerating now, something's wrong. And we think ServiceNow is going to accelerate. I think the other element that people want to see is really margins and margin leverage. If we're adopting all of this fancy AI technology internally to drive more efficiency and productivity, where's the proof in the numbers? And so accelerating growth, improving margins, and sometimes even inflecting margins, I think is what investors need to see. We think ServiceNow is going to deliver that over the next 12 months, and we're using today's opportunity as a buying opportunity.
Another buy you got, Alex, and I'll end here, Salesforce. Now this one, we're down about 40% over the past 12 months. What does Mark Benioff, Alex, what does he need to say and do to convince investors, you know what, his stock is a smart opportunity?
Accelerating growth and improving profitability. I think that similar to ServiceNow, the last 12 months have seen Salesforce embark on some large-scale M&A that they've done, at a time that was considered to be a little bit surprising for the markets. I think they've undergone a full strategic pivot around Agentforce, this agentic AI platform that they believe is the future of apps, and we would agree. So we think concrete examples where customers have adopted, not just adopted, but are actively using and paying for this technology, and it is additive, accretive to the growth rate. If they can lay that out, that this is, again, we've turned the corner on the growth, and we are back on a pathway that leads to something that's closer to double digits over the course of the next year or two, and not just in words, but in concrete proof in the bookings growth rates of this business. I think that's what investors are going to want to see, because there's a lot of companies that are private directly in the space that are putting up some serious points on the board that, quite honestly, are frightening from a competitive perspective to institutional investors.
Alex, good to see you as always. Thank you.